Okay, let's unpack this. We are diving into the Q3 2025 earnings call. And this was a mandatory listen for anyone trying to figure out where that line is between auto, energy, and, well, AI.
It really was. This was so much more than a financial report.
Yeah, it felt like management was making this radical, almost philosophical argument about the future.
I think the thing that stands out immediately is just the tension, the tension that defined the whole call.
How so?
Well, on one side, you had these undeniable record-breaking operational successes. I mean, huge numbers.
Right.
But then investors were just laser focused on near-term profitability. So you had this friction. The market was trading on today's risk while management was selling a future of like exponential AI returns.
Okay, so let's start with that operational success then, the upside.
Yeah.
Because it was, impossible to ignore.
Absolutely.
They delivered on the top line, big time. Total revenue came in at what, $28.1 billion?
Yep. That's a huge 12% jump year over year, and it beat consensus estimates.
And that revenue was driven by just sheer volume.
Right. Sheer volume and operational scale. Deliveries were really robust, landing just shy of 500,000 vehicles, 497,099 to be exact.
Mm-hmm.
But the real growth story, I think, was in the energy sector. They deployed a massive 12.5 gigawatt hours of storage.
An 81% increase year over year. That's incredible.
It is.
And crucially, this whole machine, it just generated cash.
That's the key. They posted a record free cash flow, FCF, of $3.99 billion for the quarter.
So that cash generation pushed their total reserves, cash, and investments up to an astonishing $41.6 billion.
Right. So, I mean, they are definitely not starved for capital.
Okay, so if they set records for revenue, volume, energy, and cash, why did the stock dip right after the announcement? That feels counterintuitive.
And that gets right to the heart of it, right? It raises the question of what the market values right now versus what management is prioritizing.
Profitability.
It was profitability. The non-GAAP EPS, which is, the standard measure of profit per share, came in at 0.50 cents.
And that was a miss.
A miss of 3 to 6 cents against consensus. And that just signals lower margins than Wall Street expected.
And we saw that margin squeeze pretty clearly in the key figures.
Oh, absolutely. The gross margin, so the profit they make on products before operating costs, fell to 18.0%.
Which is a drop of 185 basis points year over year.
And even more dramatically, the operating margin, what they keep after all the core expenses, declined 501 basis points. It fell to just 5.8%.
Okay, 500 basis points is a huge drop.
Mm-hmm.
For you listening, what does that mean in practical terms?
It means for every single dollar of sales they made this quarter, their operational profit has shrunk by 5 cents compared to the same time last year.
Wow.
That is a massive squeeze, and that's what spooked the short-term investors.
So why did it happen?
Well, when you dig into that profit drain, it's really a mix. You have external pressures and then internal, very intentional investment.
Okay, let's start with the external stuff.
Externally, trade friction was a major hurdle. The total tariff impact for the quarter was over $400 million.
$400 million.
And that was split pretty evenly between the auto and energy sectors. Then you pair that with lower sales of high-margin regulatory credits, and you've got serious pressure on the bottom line.
So the costs of, geopolitics and regulatory changes are big. But that still doesn't explain the whole drop. The internal R&D machine is running hot, too.
And that is the key narrative link. Operating expenses went up, and management was, frankly, unapologetic about it.
Right.
This increase was driven by specific investment spikes. Heavy R&D for AI, performance-based equity for employees in core AI development, and, significant legal expenses.
They basically said it outright, didn't they?
They made it explicit. These R&D investments are increasing because they believe the near-term margin sacrifice is essential for future AI scale.
Okay, let's move to the vehicle side. Despite those profit issues, the market showed some real strength. They adjusted pricing after the big US EV tax credit expired.
A very strategic move. They launched the Model 3 and Model Y standard versions in the U.S. at incredibly competitive prices.
Something like $36,990 and $39,990 to start.
And that pricing strategy, it clearly worked to move volume. Geographically, they saw huge sequential growth. Greater China was up 33%.
33%.
And the whole APAC region was up 29%. It just shows that global demand, even at those prices, is still strong.
And the energy division, which I feel like often gets overlooked, it continues to act as this crucial stabilizing force.
It's a counterweight, a perfect counterweight to the automotive volatility.
Yeah.
The energy storage business had record deployments and, critically, record gross profit with strong margins. It was a huge tailwind.
And they mentioned Mega Factory Shanghai.
Right, which is proving to be really strategic.
Yeah.
By supplying non-U.S. demand from China, they can bypass some of those heavy tariffs we just talked about. So the Mega Pack division becomes a real operational buffer.
Okay, so here's where the whole conversation just pivots. It goes from the profit and loss statement to this, grand future vision.
That total pivot.
Their capital expenditure plans are massive. I mean, they're targeting an annualized production rate of 3 million vehicles within 2 years.
And they justify this entirely by their confidence in one thing: achieving unsupervised full self-driving.
Autonomy. In their view, it's the only metric that matters.
And that's the core thesis of the call. If FSD works reliably, the entire value of the company changes, fundamentally.
And that conviction leads to these hyper-aggressive near-term goals.
Exactly. They said they expect to remove safety drivers entirely in large parts of Austin within months.
Within months. And they're expanding the footprint really quickly.
The plan is to scale the Robotaxi operation to 8 to 10 U.S. metro areas by year-end. They're looking at places like Nevada, Florida, Arizona.
Okay, but doesn't that require overcoming a huge credibility gap?
Yeah.
I mean, given the history of optimistic FSD timelines, how do they address that?
They pointed to the speed of their internal software development. They basically framed it not as a technical hurdle anymore, but a regulatory one.
So they believe the tech is ready.
They believe the tech is ready. The focus now is just on rapid city-by-city regulatory approval and scaling the fleet.
And the dedicated platform, the CyberCab, is a huge part of that future fleet's economic model.
Oh, absolutely. The CyberCab, no steering wheel, no pedals, is slated to start production in Q2 2026.
And that vehicle is engineered purely to minimize the cost per mile.
Right. They're shifting from selling a high-margin consumer car to selling an ultra-low-cost transportation service. The CyberCab is the physical proof of that shift.
Let's talk about the FSD software itself, V14. We heard the architecture release was jerky at first.
Yeah, and that suggests a conscious trade-off. They explain that when they introduce a major new architecture, the first priority is just proving safety. Absolute safety across millions of miles.
And only after that's locked down do they solve for comfort and smoothness.
It's a safety-first, refinement-second approach. But they are also thinking about the millions of existing cars on the road.
Right, the older hardware.
They confirmed they're working on a light version of V14 for older Hardware 3 cars, expected in Q2 2026.
So for you listening, what are the main limitations of that older hardware that they're trying to solve here?
Well, Hardware 3, while it's powerful, is just less capable of running the massive neural nets that V14 needs. So the light version is essentially a highly optimized, stripped-down neural net designed to fit into that older chip's limits.
So millions of older vehicles can still get some of the cutting-edge features.
Exactly.
And we also heard about integrating reasoning capability. That sounds huge.
It's a massive step. Reasoning means the car will literally begin to process context and make non-driving decisions.
Like what?
Things like, should I drop the passenger off here because the sidewalk is closed ahead? Or, what's the best parking spot given the time of day?
And this all has to run in real time on the existing hardware.
Yes, which is an enormous computational challenge.
Okay, shifting gears now to Optimus. If autonomy is the justification for vehicle scale, the humanoid robot is what management calls the biggest product of all time.
And the production ramp target is still late 2026.
The audacity of the vertical integration challenge here is what's fascinating to me.
It is. They see Optimus as solving general-purpose labor scarcity, starting in their own factories. But the biggest hurdle isn't the AI, which they say transfers nicely from the FSD stack.
It's the physical manufacturing.
It's physical manufacturing.
Tell us about that specific challenge.
They explicitly called out the dexterity of the hand and the forearm, replicating the complexity of the human hand, the motor control, the sensors, all of it.
Is a greater engineering challenge than the whole rest of the robot?
That's what they said. And because the supply chain for humanoid components just doesn't exist, they have to manufacture nearly every part internally, from scratch.
I mean, trying to build the mechanical equivalent of the human hand from the ground up. That That feels like a decade-long project.
It is, which is why the milestone for the Optimus V3 prototype expected in Q1 2026 is so critical.
You're aiming for extremely human-like movements.
So human-like that you'd have to get close and, poke it to realize it's not a person. If they hit that timeline, it de-risks the whole vision.
And fueling all of this AI is their specialized hardware. We got deep details on their next-gen chip, AI5.
And the performance claims are astronomical, up to 40 times better than the current AI4, or as they said, safely 10x better.
How are they getting those gains?
Through ruthless simplicity and specialization. They are designing a chip solely for their needs. It's like stripping a Formula One car down to just the racing components.
So what do they actually remove?
They explicitly deleted unnecessary legacy components, things like the traditional GPU and notably the image signal processor, or ISP.
The ISP cleans up camera input.
Right. But their neural net processes raw pixels directly, so they just bypass that step. It's a pure efficiency play for massive performance gains per watt and per dollar.
They're also diversifying the manufacturing, which feels like a big strategic move.
It's huge. The AI5 will be co-manufactured in the U.S. by two partners, Samsung in Texas and TSMC in Arizona.
And the goal is an intentional oversupply.
An oversupply. Any excess capacity that isn't needed for the car fleet gets deployed in their own data centers alongside their existing AI4 and NVIDIA hardware to just accelerate training.
Let's quickly touch on the energy scale-up again. They talked about Megapack 3 and the Megablock architecture.
Which are driving today's profit. But the real long-term disruption is the future Megapack 4.
What's the key feature there?
It will be able to output 35 kilovolts directly. And that matters because it eliminates the need for an expensive custom substation on site for most industrial customers.
So it cuts deployment time and cost.
By up to 20%. That's the real game changer for speeding up large-scale energy projects.
So if we tie all this back to that market friction, the conflict is clear. Investors are trading on near-term risk, the margin compression, the tariffs.
While management is focused exclusively on the massive exponential long-term returns from AI, robots, and energy.
And that long-term focus drove a really charged discussion about the CEO's voting control and compensation package.
Yeah, that was ahead of the upcoming shareholder vote.
Management made a very explicit case for maintaining a strong influence, right? Aiming for a voting percentage in the mid-20s.
And their stated rationale was that this control is necessary to protect the long-term vision from outside interference. He spoke forcefully about proxy advisors.
He called them corporate terrorists.
He did. He argued their short-term focus would be destructive to the company's future value, which is all based on these very long-dated bets. It's a public battle.
Okay, finally, we should just briefly mention the semi-truck timeline.
Right. The factory build-out is on schedule. We should see the first online builds of the Semi in Q1 2026, with the real volume ramp starting in the second half of that year.
All right, time now for the segment we call This Is Not Financial Advice. This is where we pitch the most outrageous but plausible trade idea derived entirely from this deep dive. Given management's focus on the bottlenecks, what's the most leveraged play?
I think the most leveraged play is hiding in the supply chain for Optimus. We just detailed the intense focus on the robot's biggest engineering hurdle, manufacturing that hand and forearm.
And they admitted the supply chain for those parts literally doesn't exist.
Right, which forces them into this massive vertical integration. So that manufacturing challenge creates a specific, immediate need.
Okay, what's the pitch?
The pitch is to short the near-term automotive margin story, but go long a basket of small, specialized suppliers of high-precision actuators and electromechanical components.
Interesting. Why?
Management is under self-imposed pressure for that late 2026 production ramp. To de-risk that timeline, they will be forced to aggressively acquire or partner with these highly specialized firms, the ones who already have the micromanufacturing tech for those complex limb components.
So these small players become the silent early beneficiaries.
Exactly. They benefit from the AI supply chain build-out long before the general market even notices.
A focused bet on the bottleneck of the biggest product of all time. That is a sharp pivot from the core business.
It is.
Okay, so to summarize the Q3 story for you, it was a record quarter for revenue and cash, but that was deeply marred by margin pressure from tariffs, regulations, and most of all, heavy intentional investment in future AI.
The path forward is unambiguous. Prioritize sustainable abundance through real-world AI and robots, even if it means sacrificing profit in the near term.
And this leaves you with a truly provocative thought to mull over.
If the in-car AI becomes so intelligent that it literally gets bored while waiting for its owner, as management suggested, and they leverage that capability, will we see the creation of a massive distributed edge inference fleet?
A computational asset measured in hundreds of gigawatts.
Built entirely from consumer vehicles when they're not actively driving. That's the real scale of the AI infrastructure they are building, right there in plain sight.